Now let's talk about PowerTrend option spread trading, and we also trade spreads with using PowerTrend, and we use a strategy which is known as an option debit spread, and option debit spreads can increase your percentage of winning trades compared to a directional option trade, because the spread trades can profit if your stock is up, flat, or down. So obviously, if you can profit if your stock is up, flat, or down, you're going to have a higher percentage of winning trades compared to directional trades, which require the underlying stock to move up in price to profit. So you'll get a higher percentage of winning trades with spread trades compared to directional trades. And we initiate bullish debit spreads when the underlying stock or ETF is on a PowerTrend buy signal, and we'll initiate bearish debit spreads when the underlying stock or ETF is on a PowerTrend sell signal. Now we're going to look at bullish debit spreads today, as most of our stocks or ETFs are on a PowerTrend buy signal. And as I mentioned in previous down markets, we did profit from bearish debit spreads using our trend following system to enter bearish debit spreads. So with bullish debit spreads, they can profit if the underlying stock or ETF is up, flat, or down at expiration. We'll show an example of that here in a minute. And to initiate a bullish debit spread, you want to buy an in-the-money call option and then sell a related call option with a higher strike price with the same expiration date. Now you can purchase the call and sell a call to establish the debit spread. Now this can be done simultaneously, or you can purchase a call option and then sell a call option at a later date to leg into the spread. So we use both types of entry methods. On some trades, we'll purchase the call, sell the call simultaneously, and on other trades, we will leg into the spread trade if we have a profit on an existing call option purchase. Now with a bullish debit spread, the call option purchase will profit if the price of the underlying stock increases, and the call option that you sell will profit if the price of the underlying stock decreases. And your risk is limited to the cost of the spread. We normally initiate spreads with 1 to 3 months until expiration, and most spreads cost between $700 and $1,200 depending on the price of the underlying stock. And you can trade a portfolio of debit spreads in a $5,000 trading account. Now the full profit potential for a debit spread is realized if the underlying stock closes at or above the strike price of the call option that you sell. So if you sell an in-the-money call option, the price of the underlying stock does not have to increase to realize the full profit potential of the spread. So that's a big difference between directional trades. If you do an in-the-money spread, the price of the underlying stock does not have to increase in order to realize the full profit potential for the spread. And most of the time we can realize a 25 to 40% return if the stock is flat at option expiration, and also profit if the stock is down as much as 10%. So we're talking about, right now we're talking about the simultaneous entry of a debit spread. And with simultaneous entry, you can normally realize a 25 to 40% return if the stock is flat or even down as much as 10% at option expiration. So obviously you're going to have a higher percentage of winning trades compared to a directional trade if you can profit when the underlying stock is up, down, or flat. And of course, a directional call option trade requires the underlying stock to increase in price in order to profit. And if you purchase a call option and the underlying stock closes at or below the strike price of the call, then of course you're going to realize 100% loss. So let's look at a current example we own for a bullish debit spread. And this was initiated using the simultaneous entry of buying and selling the call option simultaneously. Here's a monthly price chart for Salesforce. The black and red line right here represents the monthly price, and the 10-month simple moving average is this blue line right here. Salesforce is above the 10-month simple moving average. So we initiated debit spread using the simultaneous method, and our brokerage confirmation here shows that we bought to open the CRM April 135 call at 23.33, and we sold to open the CRM 145 call at 15.58. So this established a debit spread with about 2.5 months until expiration, and bought to open the 135 call at 23.33, sold to open the 145 call at 15.58. So the net debit to purchase this spread was $775, and the cost was $775. Now CRM was trading at 159.08, so when we bought to open the 135 call and sold to open the 145 call, this was an in-the-money spread, as both strike prices were below the current stock price. So again, we bought the 135 call at 23.33 and sold the 145 call at 15.58. And in-the-money call spreads give us more downside protection and a higher probability that the trade will be profitable compared to at the money or out of the money call spreads. We trade in the money call spreads because we want that increased downside protection, and also we want that higher probability that the trade will be profitable. Now we also have a option calculator that will calculate the profit potential for call option debit spreads, and of course we use this calculator before we initiated the CRM trade, and it will calculate the profit potential for the CRM trade based on the price change in CRM at option expiration. So here's an example of the CRM trade. CRM was trading at 159.08. We bought the 135 strike call at 23.33, sold the 145 strike call at 15.58, and the calculator calculated the profit potential assuming various price changes in CRM at option expiration. In this example, from a 10% increase in the underlying stock to a 10% decrease in the underlying stock. And the second row from the bottom here of the calculator will calculate the dollar profit potential. In this example, it's $225. And then the bottom row lists the percentage return profit potential. In this example, 29% profit potential. And we can see that if CRM stock is flat at 159.08 at option expiration, we'll realize the full profit potential of $225, 29% return. And if CRM is up at all, at option expiration, we'll still realize the full profit potential of 29%. And we can see that if CRM is down 5% at 151.13, we'll still realize the 29% profit potential. And if CRM is down 10% at option expiration, we'll realize a 5.4% return. So in this case, we're going to profit 29% if CRM is up at all at option expiration. If CRM is flat, we'll realize a 29% return. If it's down 10%, we'll realize a 5% return on the trade. So now profiting when your stock is up, flat, or down 10% at option expiration, this is going to give you a higher percentage of winning trades compared to a bullish directional trade, which requires the underlying stock to decline in order for the trade to profit. And again, if you purchase a call option and the underlying stock closes at or below the strike price of the call, you're going to incur a 100% loss. And we also give trade recommendations for option debit spreads with our trading service. And these are the current trades that we have, open trades, and we currently have $160,000 open trade profit and an average return of 133%. So this lists the various spread trades we currently have, and we entered these spread trades using both the simultaneous method of entry and also legging into a call option purchase at a later date. So average open trade profit right now, 133%. And again, if you want information on our trading service, you can call Brad or click on trade results, and you'll get the current open trade profits for the various portfolios, option spreads, option purchases, covered calls, market neutral, etc. So you can get an update on how these various strategies are performing by logging on to weeklyoptionalert.com and clicking trade results.